Welcome to the Impulse Strategy video. Now, if you haven't already, then please watch the Impulse Strategy content guide so you understand absolutely what everything means on the chart. There is a trading checklist which I advise you go through before we get started. First of all, the win rate. If you are expecting a 90% win rate, then this isn't for you. In almost every circumstance, an extremely high win rate is relevant to DCA bots or strategies with a pretty poor risk reward. They can make you feel good in the short term, but will more often than not, yield a lot lower profit, if any at all, and usually much riskier long term. The reality is that we will average around about 60% win rate with an average of 1.5x risk reward. Therefore, out of 10 trades, based on a 1% risk per trade, you will end up with 4% in losses and 9% in wins, giving you an overall 5% net P&L, which ain't bad. Do not watch it too closely. Do not sit there with your face against the screen, willing the market to do stuff, because it doesn't matter. The market does what it wants. Your whole point is you've done all the hard work already, and your conviction is there. If you don't feel comfortable entering a trade, don't enter it in the first place. And this leads me on to the next one, which is forcing entries. Now, a lot of the time with scalping, when you get there, by the time you get there, the price may have moved on. It may have exploded. So do not let FOMO get the better of you and try and chase those entries. As it may be very tempting to hit that market buy or market sell, it can also lead to an extremely bad risk reward and put a lot of risk on the table. Sometimes when you are watching a trade and the price is eking ever so close to your stop loss, it can be very, very tempting just to increase that stop loss ever so slightly. What this is doing, it is putting your strategy completely out of sorts. And 9 times out of 10, you are not going to catch that knife. Unfortunately, it will hit stop loss and you'll just end up losing more. Stop losses are there and predefined for very, very good reasons. That being said, you can increase it by like 0.1%, 0.2%, depending on the size of the trade. The stop losses given to you by the strategy are based on the exact swing high or swing low or candle high or candle low. So by giving it that extra 0.1%, 0.2% room, it'll give an opportunity for the trade to bounce from that point because that is quite a significant price point. However, anything beyond that is just a little bit careless. That being said though, for take profits, once the trade is open and you have, I don't know, some amazing news like Disney has now adopted Ethereum and the price is going to explode and you have an open Ethereum trade, then yes, by all means, increase your take profit. That's what we're here for. Now, I do suggest that if this does happen, to raise the stop loss to break even, because what that does is at least you won't lose any money on it. You won't make as much if it goes the wrong way and you make the bad call. But make sure that you are healthily in profit before you do this. Now, this strategy is founded on risk, and risk basically underpins how all of the trades in this strategy are set up. It really helps you keep in control of your risk. Talking about alerts, so alerts are going to be extremely important with any of these kind of strategies if you don't want to sit there staring at your screens all day. These alerts are included in TradingView. Now, depending on how many alerts you need or want, depends on what subscription you have for TradingView. The higher the subscription, the more alerts you can get. You can get up to 400, which is probably way too much for a lot of people, but it also completely depends on what kind of trading style you're using. The right amount of alerts for the kind of strategy that you're going with. Sadly, for the most part, it is highly advised to have multiple screens, at least 2, because one is where you're going to be doing a lot of your technical analysis, i.e. on TradingView, and the other screen is where you're going to be placing your trade, using an exchange or a smart trade platform. However, there is an option that we'll talk about during placing your trades video series later on, where you can actually just use one screen for everything. I touched on it earlier on, TradingView, it is a non-starter without TradingView. You simply need TradingView if you want to do this strategy because that's where all of the indicators live. Without TradingView, then, well, you can't use it. Then lastly, for this trading strategy checklist before we get started is practice, patience, psychology. They're pretty much all the same thing. Depends which way you look at it. This is not an overnight to riches thing. Low risk trading rarely is. So you will have to train yourself to endure the losses before you enjoy the riches. You can help yourself get there by utilizing the paper trading function on TradingView and become an impulse strategy ninja before you risk a single sat. So now you have that checklist in front of you and hopefully all checked off. Let's take a look at how to actually use the strategy. We are going to kick off with the Impulse Scalp wave signals. Now from the content guide you will know that the wave signals are the pink and green triangles, lines on the framework itself and also which oscillator it is. So we'll remove the impulse momentum and the impulse swing and also the impulse momentum signals so we can have a real clear look at what we're aiming to do. What we will do first is we will go through what a perfect signal is and what a perfect signal isn't, and also a subjective signal as well. Then we'll go through all of the exact rules for this strategy. What we are looking for this strategy, first of all, is we need a sell or a buy signal from the impulse wave, which is signified by a green or pink triangle. This is the first part of entering into the signal. The next one, we need a confluence from the impulse wave. So the confluence that we're going to be needing is the impulse wave line needs to be overbought for a short signal or oversold for a long signal. Additionally, the impulse wave line needs to be in a bearish momentum, i.e. pink, for a bearish signal or short signal, and also a green line for a bullish signal or long signal. As we can see just here, we have a signal that we can enter. We have the sell signal in the triangle, and also we fall in a very nice ideal sell zone because the alpha wave line is overbought and it is turning down as well. This is also indicated by a colored background. So as we talked about in the guide, the pink background is an ideal sell zone. So this signal is valid to enter. Now let's look at how the trade is set up. We will be entering pretty much as soon as possible, but as mentioned earlier on, we don't want to be chasing the signal. So if you see the price shooting down here on this candle, then don't enter somewhere in and around here. We want to be entering around ideally at the close of the signal. And we can see that our stop loss is just here. We can even add on a tiny amount, 0.1% let's say. And then here are our targets. Now optionally you can check out the back testing data, which is going to be a link in the description below, in the differences between a 1.5x target or a 2x target. Or you can do a split between them, 50% at 1.5x or 50% at 2x. Personally, I use 100% of my take profit is at 1.5x risk reward. So there we go, we have the trade set up exactly as if we would enter it. We'd enter it on the candle close here of the signal. We'd put our stop loss to where it's indicated on the pink horizontal line. And we'd put our take profit to the horizontal green line. And as you can see, indicated by the short position tool on TradingView, we have a 1.5x risk reward. Our stop loss is 0.85% and our take profit is 1.28%. And the trade goes on to be successful. Now let's take a look at a long signal. Here we have a buy signal being indicated just there. And also we are in a lovely green zone because the price is oversold and it is also moving up. So let's set this trade up. There we go. We'll be entering just here on the close of this candle, as this is when we'll be coming to the trade from the alert, or if you're watching it. And we'd set our trade up to 1.5x, which is around about there. And this trade goes on to, well, actually hits take profit in that single candle right there. Make it a little bit bigger so you can see. And there we go, that would be the ideal signal because it just shoots straight up and takes profit in one candle. Okay, now you understand how the signals look and when to enter. Let's take a look at the rules and the framework on how to make this specific strategy, the impulse scalp wave signals, successful. The required tools that you will need is TradingView, the impulse scalp indicator, the impulse wave indicator, and also a trading terminal, whether it is a smart trade platform, an exchange, or TradingView. There's 3 sections to a trade, which is the pre-trade, the active trade, and also the post-trade. The pre-trade is what you need to be doing before the trade kicks off, i.e. timeframes, what assets we're looking at, and what exchanges. In this case, the time frame that we highly recommend you be using for the impulse scalp wave signals is the 15-minute time frame. If it goes any lower, then you tend to get a lot of false entries, and it simply just is not very effective on higher time frames. But we have found the best results appearing on the 15-minute time frame. That being said, please do your own back testing and please check it out, because there is no way that we can personally check every single time frame with every single asset. So for assets, this is designed for futures. Why? Because the fees are generally lower on futures and you're going to be scalping a lot with much tinier targets. So you're going to be wanting to be using futures for crypto if you're trading on this. Plus you get the benefits of trading both up and down. We advise using the top 20 market cap. Why? Because there's plenty of liquidity and they're quite popular amongst all exchanges and also platforms as well. If you're going to be using Forex on MT5, for instance, then we recommend the Forex majors. Basically anything with a really nice tight spread. And also, again, as it goes with both of these, try to use limit entries for both of these, but we'll talk about that later on. Exchanges and brokers, really the higher liquidity and the lower the fees, the better. So keep hunting around to which ones have got the lowest fees, and that really is a great starting point. So the next step is the active trade, i.e. what are you doing in order to set the trade up? The entry price is always going to be the signal candle close. Remember, do not chase the entries, and the entry type is going to be ideally a limit order, which are quite easy to do if you're scalping because you can get everything set up. And when you look through the place of trade videos, we can show you the most efficient way of doing this. A long stop loss is the candle low. So looking at the stop losses for the impulse scalp wave signals, we are using the signal candle low, which is indicated just here. Or if it was the other way around, the signal candle high for a short, which would be at the top just there. Now you can add an approximate 0.1 to 0.2% margin on that, just to help give your trade a little bit of a chance to bounce off the bottom or the top, and also go on to take profit. For the stop loss type, always use market orders. This can lead to a tiny bit of slippage and not ideal fees, but the whole point of a stop loss is so that you do not end up with a wayward trade, which limit stops can end up doing. So if you're going to go to stop loss, you want to make sure you're getting out of that trade. The take profits, I recommend using a 1.5x risk reward on it, which is the first target of the default settings. The number of take profits, I generally like to use one take profit, so 100% all in or all out. The take profit type, then you have a couple of options. It is not quite as critical as the stop loss, then that if you do miss it, then you just don't take as much profit basically, which is a bit of a shame. Or you might not even actually close the trade because it just wicks it ever so slightly and there's not enough liquidity to fill, which again sucks, but it does mean that you do sidestep the fees and you get the exact price that you're going for with no slippage. However, I would recommend that if you are leaving the trade overnight, then to use market orders, just so that you don't have anything to worry about. If you're following the trade and you're quite active on it and it's nearing where you are, if it's nearing your profit, then you can flip it to a limit order. Again, to really nail the exact price that you want to get out at and also lower the fees. So we have gone over the conditions on when to enter a trade and when to not, as we have seen in this video. And then there are But let's take a look at a couple of extreme exit conditions, i.e. why should you choose to close the trade early? And there are a couple. One is, well, Fed news. If we happen to have a bunch of trades open and Jerome Powell takes the stand and it's something particularly bearish and you have a lot of longs open, then I would advise to close them. And then the only other case scenario is when we have scenarios which could be like this, which if you did have, let's say, a limit order or a limit take profit on and the candle wicks up and it clearly breaches the price and it retraces but your trade is still open, then I would advise to close that because that is basically your trade invalidating. Because you've hit the target. I know on this scenario it does go on to hit take profit, but in this scenario it could hit that and retrace all the way down and hit stop loss. So it is best to close the trade if you find that it has got within 0.1% or even breached it in this scenario, and just basically save against any unfortunate errors of it going to stop loss. On to the risk per trade. The risk per trade is vital. I'd recommend that you keep consistent with it. There is no one exact answer to this because it's dependent on the frequency that you trade, your overall risk limits, if you're following any funded account rules, and also your balance as well. So with risk limits, I tend to stick to around about 0.25% per trade because I trade quite frequently. I keep my trading accounts relatively lean, and I'll only ever up that if I'm feeling in a particularly frisky mood. But for the most part, I stick to about 0.25%. However, make sure you check out the whole risk guide and strategy within the wiki on the website, as there is a full in-depth there on how to basically calculate a personal risk per trade. Post-trade, this is once the trade is open, and what you should do in regards to stop losses, we touched on that before, increase it by 0.1 to 0.2%. just to help give it a bit of breathing space for a bounce, and then take profit again if there's any particularly major bullish or bearish news going in the same direction that you're pointing, or if you happen to be on the wrong side of a resistance. This is all covered in the advanced guide on the website, but for instance, if this was the resistance just here and we got given a take profit, make sure you check out the advanced import strategy guide on the website, as it is all covered there. Then lastly, let's talk about a subjective trade. So as we can see right here, we have a subjective trade in that we have a great signal. However, we don't have the full confirmation of whether to enter it or not, because whilst we are overbought, which is a great condition for a short signal, we haven't started to turn bearish. But what we would find is that if we waited for a candle, or maybe two, then we would start to see this trade turning bearish. It is subjective for a good reason, because you need to use some of your, trader knowledge, instincts, maybe check out the advanced guide in ways to determine whether to enter this signal or not. So there are multiple things that you can use, whether it is various other indicators or such things as an RSI divergence, in which we can see just here, in that the trend is going down on the chart. However, the RSI is going up, which means there is a bit of a divergence occurring. So it is likely that this trade will continue down, which lo and behold it does. So that would be a subjective or borderline trade. Next on the docket, we have the impulse momentum signals. So let's get all of those set up. I'm going to turn off the wave signals, turn on the momentum signals, as easy as that. We'll turn off the impulse wave and we'll turn on the impulse momentum. So let's see what signals pop up now. And as before, we'll look at what constitutes a good signal and a bad signal for the impulse momentum. Here we have a good signal because we have a short triangle signal on the impulse momentum, but also down here as well we have a good recommended sell zone, in that the bears are in control and the momentum is up. So if we'd set this trade up the exact same way we set it up as for the impulse wave, in that we enter on the candle close or as close to the candle close of the signal candle as possible, we set our stop loss to the suggested stop loss, and also we target one or the other or both targets down below, and we aim for that 1.5 risk reward, or whichever risk reward that you're going for, whether it's 1.5 or 2, and that is your trade setup. Of course, all the same rules apply. Don't chase it, don't go into a market, use limit if you can, and make sure all the conditions are met. Let's take a look for a long, and here we have a long opportunity. We have a long signal appear, and also we are in a very good suggested buy zone. And again, exact same rules apply. We take the candle close entry, we set our stop loss to the recent swing low in this case, and then we target TP1 or TP2 or both. So around about a 1.5x risk reward for this case scenario. And as we can see, the bulls are in control and the momentum line is up, which means the trend is jazzy. So here we go, we have a false signal just here, in that we have a suggested buy there. But when we take a look at the impulse momentum oscillator, we see that the bulls are in control, but the momentum is extremely low. This means that we're probably in an area of consolidation. Now, it's not too hard to see that we're seeing a bit of a turn in the trend here. So we probably don't want to be going long if we're going to use some of our technical analysis, but we don't have to do that because the impulse indicators are telling us not to enter this signal. And had we have entered it, then the price instantly goes down after that and we would have got stopped out. So let's take a look at a subjective trade on whether to enter or not. So let's take a look at a subjective trade. So one of the things to check out the advanced section, because it'll help give you a bit of an idea of what to look for, and also some confluences outside of these indicators, but whilst also using the indicators as well to deem whether it's a good entry or not. We have our buy signal appear, but unfortunately what we see at the moment is we don't have a recommended buy zone appear, but we do see that the bulls are quite heavily in control at this point now. Most significantly, we can see that the momentum line is rapidly rising. So that means that momentum is kicking in and it's rising up. So it might not be above the golden 20 line, but it is increasing. So if we were to take this trade based on that analysis, we would end up with a winner. Let's take a look at some of the rules and tools that you're going to need for this. You're going to need TradingView, you're going to need the Impulse Scalp, you're going to need the Impulse Momentum and Trading Terminal, Smart Trade Platform Exchange or TradingView. Exactly is the same for Impulse Wave. Everything else in regards to the pre-trade, such as the time frame, the assets in the exchange, applied exactly the same as the Impulse Wave. The major difference between the two for the Alpha Wave and Alpha Momentum is the stop losses. The stop losses for the Alpha Momentum is based on the swing highs and swing lows, whilst the Alpha Wave is based on the candle highs and candle lows. So usually the waves are much quicker, momentums can be a little bit longer time frame on them. Outside of that, absolutely everything is the same. Now lastly, let's take a look at the swings. So with the swings, we tend to use a high time frame. The greatest time frames for these are the 1 hour, 6 hour, and also 12 hour. We don't need any other confluences in order to use these. It is simply a point and shoot indicator. So we get a signal from the orange triangle, as we can see just here. The stop losses are set to a longer swing high or swing low. We have the risk reward targets on there. And it really is as simple as that. If you're familiar with the scalping style, then it is no different from that in that we enter at the candle close, we set our stop loss to the suggested stop losses, and we set our take profits to the suggested take profits, and we go on from there. But there are a few differences in the recommended setups for these trades, which we will run through now. And let's take a look at a long example. We see we have a long signal just here. So let's set this trade up. And it's great with the high time frames, you don't have to rush these as much. The other confluences I guess that you can use is just wider market information, whether it's news, whether it's general market trend or macro trends, and what Bitcoin's doing, I guess, is the biggest driver here. And it's so simple to set up. Let's have a look at some of the rules and tools that you'll need for the Impulse Swing. You've got TradingView, Impulse Swing, and also Trading Terminal in a smart trade platform, exchange or TradingView. The pre-trade setup is suggested timeframes 1 hour, 6 hour, 12 hour. And the assets, which I personally use, if you're using futures, then use the top 100 market caps. If you're using futures for this, then use the top 100 market cap. If you're using spot, then you can use all of USDT and all of the BTC, even all the shit coins. And then lastly, for Forex, you can use majors. Exchanges and brokers, same as before, use some of the highest liquidity ones or even some of the ones with the biggest availability of assets. Binance is great, but as always, lower the fees, the better. So the entry prices remain the same in that you enter on the candle close. Really with these ones, you can enter with limit or market order. Because the targets are so big, it doesn't really make a huge difference in regards to the actual, slippage itself. And exact same with Forex, if the spread is low, it doesn't really matter too much. Stop losses, same applies with these. Give them a little bit of breathing space around about 0.1, 0.2%. And then stop loss type, make sure it's market order. No reason to use limit orders for these. The take profits are a little bit different, however. So with the 1 hour, basically only use the risk reward mechanism and heavily advised to use 1.5x risk reward for the 1 hour time frame. If you're using 6 hour or 12 hour, which is the other recommended time frames, then it is advised to use a fixed take profit structure. If you check out the backtesting data, then you can see the recommended take profits just there, which usually sits around about 5%, 10%, 20%, 50%, and 100%. So you're making use of all of those 5 take profit targets. Then everything else remains the same in regards to the exit conditions and also risk per trade, usually around about 0.25%. One thing to be aware of, if you are using quite a small risk per trade and a lot of take profits with a big stop loss, your actual entry amount or entry volume for that trade will probably end up pretty low if you're using a relatively limited balance, which means there are occasions when you might not be able to close the trade. If you're only taking, let's say, 20% of your profit at TP1, 20% of your volume may actually be like $2, which most exchanges can't accommodate. Binance's minimum volume for the exchange is $10. So, for example, a trade at 10%, I believe, would have to be at least $50. So it's something to be aware of, that make sure that the trade amount is enough to accommodate all of the staggered take profits. And there we have it, guys. That is the strategy of how to apply the impulse indicators into your day-to-day trading. The next videos to check out will be how to place a trade, which we'll be looking at how to place them efficiently and also what platforms we recommend.